Oh, today what we're going to talk about, now that we've sort of finished up our initial or our conversation about building portfolios, putting stuff together, analyzing the stuff that goes in them, now we're going to talk a little bit about what comes after what we do after we've finished our plan, after we've built our portfolio. So before I get into that, 3 p.m. again today, forum at Mendocino Hall 1005. What goes down the drain counts. So you'll be learning about the sewer. Nice time for Halloween. So I guess ready for that. Nice. So let's go over a little bit of the stuff that we talked about last time, sort of to wrap up our conversation. These investment objectives and risk tolerances are really important in the next part of our planning in the role of our monitoring and making sure that everything stays in line. Because making sure that we know that we are still aligned with these also plays part of that role. As long as I know that I'm a balanced investor, it's very easy for me to look at a balanced portfolio and know that's for me. But if I change to current income or I change to growth, that's an important change to make. So we obviously have our investment objectives like we talked about last time, all the way from capital preservation to growth, sort of in order of risk, but really mostly talking about what they're trying to achieve. So trying to preserve as much of the initial capital as possible, trying to generate income upon which to take monies out of, a balanced approach that's sort of in between them all, and a growth objective that doesn't look to generate income, but rather seeks to appreciate the capital as much as possible. That's not to say that there won't be equities or there won't be pieces of growth in current income and there can't be income producing investments in growth. It's just more about what's the overall objective for the collection of capital. Next, then we have our risk tolerance. And as you'll see for our purposes, what I see in the systems that I use in our office, you'll see some overlap. So capital preservation and capital preservation both are a risk tolerance and an objective, because it's really just how really close to a cash account, taking on pretty much no risk as much as possible, but really just looking to keep a nest egg together and not lose anything during volatility. Then you can have conservative, moderate growth, and aggressive growth, all just sort of talking about how much volatility, how much standard deviation is a person ever willing to endure. For the most part, like literally 90% of people that I talk to that are pre-retirees or retirees hit in that moderate category. And the odd one usually falls into a little bit more conservative. Not a lot of people up in the other categories, most of them right in that middle. And it's just can be a healthy place to be because you get to feel a decent amount of the market, but also you get some protection from fixed income and stuff like that. So it's never a bad choice to be the average. So the thing we talked about was the types of risk that we're diversifying against and that we're managing for. So this is all stuff that we've talked about many times, but just kind of a reminder of the things that we're looking at. We went back over our stages of lateral integration, how I like to view portfolios when I'm building them, or how I like to help people structure the funds that they have. Looking at our immediate needs in our stage one to make sure we're including things like RMDs, so any withdrawals that are coming out, any other one-time expenses, plus a bit of a volatility buffer. And I've been playing a little bit with creating a tool to hopefully be able to put something together where you would be able to put in your account balance and put in the different features that you want to have in there, and then have it create sort of a distribution across these stages. So I'm sort of workshopping that, and hopefully that will be some of the things that you'll see appear on our website in time. In stage two, we start talking about needs that are a little bit further away, or if we want to be generating income without taking on a huge amount of risk, or if we just want to have sort of moderate volatility in the middle. That's what our stage two lateral integration will do. And then stage three is really that forward-looking, long-term appreciation, looking to offset inflation. If we are looking to self-care our long-term care and we've got some time to go, we better get going into those equities that are looking to appreciate so we can increase that value and pay for as much care as we can. And then also for any long-term goal funding that sits out there in the future that we can wait for the average returns for. Then we have our vertical integration, sort of just showing that again, how we start with our low-cost investments, always starting with the stuff that doesn't cost an arm and a leg to get in there to get the performance of the market so that we don't lose unnecessary performance to fees. And then if you want to tilt yourself towards a sector of the economy or a factor that you believe is due for either outperformance or it's just something that you align with more and you would stay the course better with. And then, of course, our higher cost or even speculative investments all the way up at the top. Obviously, with our fixed income funds, I get a little bit more liberal with our cost. I would usually say that if I'm looking at equity investments, I want level one to cost less than 10 basis points, so 0.1% or less. There's just not really much of a reason for it to cost much more than that to get across the board diversification. Now, when it comes to sort of tilting one or the other way, I might pay 15 basis points or maybe up to 20 basis points, 0.2% or less is really what I'm looking for. Because again, for me, I'm doing the choice here. I want broad index, complete diversification. And then if I'm going to tilt in a certain way, I want to be the one making that decision. So for example, a lot of the times what I like to do for people is a broad total stock market index and then just sort of tilt away from the tech a little bit with a value fund because it's just not going to contain those same top holdings. So we just get to just scoot over a little bit away from those super high allocations. But I don't want to pay 30, 40 basis points for that because they're effectively doing the same job as the people down here, just with a little bit of a filter put on it to look at a couple numbers every quarter or so. So I still want to pay low cost. When it comes to managed stuff, really, I mean, it's up to you, especially depending on how large of a portfolio it is. But I just don't want you to have such a high cost position up there that either the cost is eating away all of the extra performance you would have gotten anyway, or it starts to really affect the average. Now, hopefully, if you follow our guidelines with how much of the portfolio these will take up, you could put a 3% net expense ratio up in here, and it's still not going to bring you to a high expense ratio. But if I flip over and I look at fixed income funds, I'm more than willing at level one, depending on what type of investment it is, to pay more like 25 basis points, right? If it's something like a short-term treasury bill fund where all they do is buy treasury bills, okay, yeah, I don't want to pay very much. I want to choose something that's still within that 10 basis point range. But say, for example, it's a managed fund and they are doing, like, for example, PIMCO's income fund or Dodge & Cox's income fund or any of these big bond funds that are good at their job and they provide good risk-adjusted returns, I'm okay paying 35, 45, even 50 to 60 basis points for that. Because if you look at the total returns and it adds up and it's worth it, that fee is worth paying. Yes.
I'm unclear any basis points.
Sure.
I'm paying 1% to someone who's managing part of my portfolio.
Yes.
I don't even know what I'm paying others, but I do know that this one I'm paying about 1.2%.
Yeah.
What are basis points?
So a basis point is really just a percent of a percent. So if I said 50 basis points, that would be half of 1%. So for your advisory services, you're either paying 100 or 120 basis points, which is fairly average for the industry. Yeah.
But in addition to that advisor, are there basis point fees?
Yeah. So the question is, are there additional fees on top of the advisory fees? So one thing that is important to understand, and we'll talk about this when we talk about hiring an advisor in our last presentation, but when you pay those fees, those fees are only getting paid to the professional that's being paid to service your accounts. The products that they use inside of your account charge their own fees. This is why I'm a big fan of low cost index investing and all sorts of stuff, because if I'm already charging my client 100 basis points, I don't want to be racking up a bunch of extra cost on top of that. So really, if you were to factor everything together, an average portfolio, if I think about all the statements that have come in that I'm looking at, so this is biased from my experience from people who I've looked at their portfolio and then brought them into my book of business. If I were to really look at what they were paying on average, it was probably closer to 160 to 170 basis points, or 1.6 or 1.7%, factoring in the advisor fee, usually 1 to 1.2%, plus the management fees of the funds. And from the portfolios that I see, they're often 40, 50, 60, or 70 basis points. Yes.
What's the highest advisor income fund you've ever seen combined?
That I've ever seen combined? Okay, well, it kind of depends. There was a prospect that came in, and one of her funds was this, I think it was by Holbrook. I can't remember if that was the company or not, but their net expense ratio was about 2%, 2.5%. And so that was for a pretty big position. I think it was 20 or 25% of the account. So 25% of the account was already paying 2% of a management fee on top of the advisor who was charging 1% to put that person in there to give them the privilege of paying that money. So that could have been a 2% or 3% total fee structure. And I've heard of that before. I've heard of advisors charging 1.5% and then putting people into funds that charge 1.5%. And there's a total of 3. So it is important to consider that, okay, if my advisor is going to charge me this money and they're putting me into these products, is it worth it what I'm paying for him to charge that? Or is that something to where maybe if I'm paying him so much, he should be doing that himself? So that's just kind of something to consider. But at the end of the day, basis point is a percent of a percent. So whenever I say basis points, it's 100th of a percent. So here's a couple of the risk and return metrics that we talked about before. Our relative risk and return. So beta is just kind of, relative volatility. Alpha is your excess returns on an investment, factoring in the relative volatility. And R squared, again, being sort of what returns are explained by something that happened in the index we're comparing it to. Just kind of the similarity, not necessarily of the composition of the holdings, but the similarity of the returns and how they moved on each individual period. Then we've got our sort of non-relative, or what I call absolute risk and return statistics. So things like mean return, which is really just what, based on all of the different probabilities that have happened, and then we're sort of averaging everything together, what's the expected or the average value of all those returns that we can expect in this next time period. Our standard deviation, which is really the band around which sort of it gives us the channel upon which we can expect a lot of our returns surrounding that mean return. And then Sharp being how much excess return did we earn based on the amount of standard deviation or risk, absolute risk that we took. And then our couple other metrics, value at risk, one that I've been finding really interesting because it's an interesting way to sort of frame that, which really, again, is kind of another way of just representing standard deviation or beta or anything like that. But it's just kind of giving you an idea of what's the potential loss of an investment at a given time frame. So it's sort of like if you were to say standard deviation, but only the downside for a specific period of time. So if I'm saying monthly value at risk, what I'm saying is what's the potential negative standard deviation of this time period? So am I going to see a loss of 5% or 10%? So kind of giving you a confidence level of how much loss you could get from that position. Then Sorrentino really just being if you took Sharpe ratio, but you excluded all of the positive standard deviation and only looked at the downside risk. Because as Sorrentino said, downside risk is the only risk we care about. Upside risk is, well, it's return. And then we also had our basic allocation guideline. So again, if we're thinking about cost, if we follow this pretty well, this gets us a pretty inexpensive portfolio. I'll remind you, I'm just going to pull up the portfolio that we built before to kind of show this off. Let's see, active retirement investing, and I'll pull a sample portfolio. So this is the portfolio that we built before. And you'll notice the net expense ratio is 0.13%, or that would be 13 basis points. So if you were in, a portfolio that was charging, let's say, 65 basis points for the average of all the positions, well, I would have, changing to a portfolio like this would already save 0.5% per year indefinitely in costs. And it's important to recognize that these sorts of percentage costs, they really stack up over time. And me personally, Like I would much rather pay that to somebody who I can face to face get service from, like an advisor or a planner or somebody who I can interface with directly, rather than just the fund company I will not even, like, I might get a proxy invite for a shareholders meeting for, right? Like I would rather divert that capital into a relationship that actually is more beneficial for me. If you're getting tons of extra return out of it, great, and then you're paying for what you're getting. But if you're just looking for that diversified exposure, if you're looking for a well-diversified portfolio, and you're gonna spend that extra money, rather than spend it on the funds, I would spend it on a professional that you can develop a relationship with so that they can make sure that they use the right products and the right solutions for you. And again, if you just follow this decently for a balanced portfolio, obviously tweak the stages for your risk, but follow these layers and kind of think about those cost metrics I told you, and you will end up with a fairly inexpensive, well-diversified portfolio. And you probably have already done a decent job yourself, but just being able to see that all together, I think would be really nice. So now let's get into what we are actually going to talk about today. Today, we're going to talk about planned maintenance and monitoring. This is one of the most important parts of all of this, because keeping on track is not just about staying invested in the S&P 500. It's about making sure that all of the work that you've done to create this optimal plan, to pay the least amount of taxes that you can over your lifetime, to invest in the proper ways, to have the backups, to do this thing, to leave this tax efficiently, to make sure this person gets this asset at this right time. All of this stuff that we've done, it doesn't really matter if something changes and then it breaks. Like, for example, what if one day the mega backdoor Roth conversion that a lot of people use in their qualified plans suddenly goes away, but doesn't just go away, it goes away retroactively. Now they have to go back and maybe have to pay taxes on a lot of extra money, or they have to pull money, move money away, and then there's penalties. But if you never know that that happened, you never change anything, who knows what the IRS would have for you later down the line when they finally figure it out. So anyway, there's three pieces of portfolio monitoring that are important for us. Or the three phases of monitoring that are important. In portfolio monitoring, estate planning maintenance, and tax efficiency management. So the things we want to make sure happen are, does the portfolio continue to serve our goals and objectives, asset classes and types? Are the cash needs filled from stage one? Do we have the right risk tolerance? Are we still within the right standard deviation or beta or duration, all of the different types of risks that we're taking? So for example, we've got an investor that's invested exclusively in growth stocks up until this point and has seen massive returns year over year. Maybe they have a lot of NVIDIA, Microsoft, Google, all that kind of stuff, lots of big gains. No bonds, no bond funds. He's not earning any yield, just the little bits that come from maybe like an S&P 500 fund. So we're going to assume that the distributions here are going to fund retirement, and that the present value or the amount of dollars in the account right now is sufficient for that purpose. We're able to distribute that out. We're going to be okay with a little bit of return. We can pay this out. So we're going to assume this is what the portfolio looks like. I've just used two funds that are just two super cheap total market index funds to represent all of those equities. So we've got 77% US stocks and 23% international stocks with an iShares fund and a Vanguard fund. Both of those are very low cost, by the way. So not that they are specific recommendations, but they're something that you could look at as something to compare to when you're looking at those types of investments. As this investor nears retirement, so as we get to the point where they're going to be ready to start taking distributions, what's a challenge they could face if nothing about their allocations change? If we stay exactly in this 100% stock market allocation, what's something that could happen from now until the first distribution? Have any ideas? Well, you can have a pretty big drawdown. So what we're looking at right here is we're looking at that portfolio. I took that portfolio and I looked over this time frame that starts, I believe, about 2015, and it goes up whenever this was updated earlier this year. So this is a graph of the percent off of the high of any part of this time frame for that portfolio. Remember, it's 100% stocks. So these are all the different times that this portfolio would have suffered a drawdown. And in fact, there was a point where this portfolio was down almost 35% in total. When a lot of people distribute assets, they distribute based on what's called the safe withdrawal rate. If you've heard of that, it's essentially the study that somebody did. They went back and they were looking at taking out different percentages of a portfolio, of a 60-40 portfolio, and they were using every single bit of market data that they could possibly get their hands on, running it from different time periods, starting every single different year, different quarter, different whatever, just starting at different times and seeing how many of these time frames could the portfolio survive. How many times did the portfolio make it all the way through whatever 30-year or lifetime period it was, and continue to distribute assets out at that 4% rate, or at some withdrawal rate. So the rate that succeeded, that the highest rate that succeeded, the highest level of times was 4%. About 4% of the account allowed it to recover and build value while still taking distributions. One thing that's important to understand about that, however, is our expenses don't exactly follow the performance of the stock market, do they? If the stock market goes down by 50 cents, does your grocery bill also drop in half? Does your car payment drop in half? Does anything else reduce? Not really. It all stays the same. You might see a little bit of changes from economic struggles, but it's not like the day that the portfolio drops, your grocery bill drops in half too. So we have to know that when that happens, that 4% is now a relative piece. So if our portfolio drops by over a third, so do our distributions drop by over a third, unless we're on a fixed distribution plan. So this is the main risk that we are looking at when we have a total stock portfolio or a high risk portfolio when we're looking to take distributions. Because if we're taking a fixed amount of assets every single year, if we're taking out $50,000 every single year, and then our portfolio drops by a third, here's the problem. Remember how we said 4% was the number that succeeded the highest amount of times? Well, if your portfolio drops by a third and that 4 changes to a 6, the math breaks. The math completely breaks. It's no longer a safe withdrawal rate, because now, as long as the market stays in that depressed state, you have to take a higher percentage of assets each year. And now the portfolio has to perform better to make up for those distributions that you took, right? So here's sort of a graph to represent this idea a little bit more. We've got two $1 million portfolios, Investor 1 and Investor 2. We've got 18 years of retirement here, it looks like. So Investor 1 experiences a 15% decline during the first 2 years of their retirement. Now, Investor 2 experiences a 15% decline during the 10th and 11th years of retirement. So when you have that immediate decline, but now the same withdrawals are being taken out. So we're, I think, I don't remember, I think it was like $50,000, some fixed amount. That initial value immediately drops, and now they keep drawing down from this lower value. Versus, if the value has been able to sustain and then it drops later, they're actually able to maintain all the way through. And so what we call this is sequence of returns risk. So this is something where there's this very, very big influential figure. He's got a radio show, he's got a big YouTube channel, and his name is Dave Ramsey. He's pretty much your no debt, don't ever take on debt for any reasons, even for business, like all cash type of person. And for a lot of normal people with really, really bad spending habits, he's a no credit cards, don't even use them to get points, like completely disregards the idea of debt entirely, which can be fine for people that need that sort of structure. You can build a perfectly fine life doing that. But the one thing that I really will disagree with him on is what returns you can expect to get from your portfolio and how much you can expect to safely withdraw. Because he will just casually toss around growth stock mutual fund 12% a year. Just 12% a year. Yeah, we're going to get 12% a year indefinitely. And you can withdraw 8 because that leaves 4 on the table. 8%. We had just talked about somebody who had done who has continuously done decades of study on every single period of stock market performance, and the safe withdrawal rate that even still failed sometimes was 4%. And now we're talking about 8%. That's a really big shift, and it's just something I don't necessarily agree with. Fine with a lot of other things. His ideas of how easy it is to afford housing are also kind of funny, because he thinks that everybody should get a 15-year mortgage, and those are very expensive
When you're
nowadays.
saying that, it's sort of agree, but when you're saying that, 8% is.
It just, what happens is there are times that it can succeed, yes, but it just greatly reduces the probability of success. Because if you think about it, you kind of think about it as like, if you go all the way back from before the Great Depression, every single year we're going to start a portfolio and then start withdrawing a little bit of it. So each of those different time periods is now a different test, right? It's like a big statistical analysis. So in some of them, where the stock market mostly goes up and the dips aren't too small over bull markets, that portfolio, that returning 12-ish, fine, and withdrawing 8 does fine. But then if you have a really large downturn, especially early on, that 8% withdrawal rate reduces that initial principal bounce by so much that there's absolutely no way that even if it returned 15 to 20% a year, it's just not going to compound enough with you still taking 8% out of the returns to make it back and live for as long as the portfolio needs to live. So again, it's like, 8% withdrawal rate might work fine for 6 years, and then it's over and the account's zeroed, but we need it to last 20 years or 30 years or even further to pay for beneficiaries, right? So that's kind of the idea. So again, we call this sequence of returns risk, because there is a risk that the sequence of returns is not indefinitely positive. Not every single sequence is going to be 8%, 8%, 8%, 12%, 11%, 10%. No, not even close. And this is the reason why we want to have all of our expenses in stage 1, as well as even a volatility buffer. Just if you want to see some lower volatility, just chuck some extra in stage 1 if it makes sense, because we need to be able to plan for these events. Here you can see again, there are these drawdown periods. These are, so stage 1 protects us in these periods, because you see these drawdowns of like almost 30%. You see this drawdown of over 25%. You see these drawdown periods, all of these returns where it really pulls down and drags us down. We want to make sure that even during those points, we can still distribute the right amount of income, and we're not, our portfolio value isn't reduced by a bigger amount. So remembering back to that investor that we talked about before, I know there was a lot in between there, but if we remember back to this person here, they've got a 77% allocation to US stocks and 23% to non-US. Well, we think about, how would these concerns change the investor's goals and objectives? What's likely to change here? Well, probably the goal is going to move away from something like growth, because now we have enough money. Remember, that was part of the prompt, is we had the present value is sufficient. So we don't need to grow the account anymore. Maybe we need to combat inflation a little bit. Maybe we need to make sure we don't lose our money, but we don't need to be in a full growth mindset. Our objective is, so that would be our objective. And we also just don't want to take on too much risk. We want to probably reduce our risk tolerance, because it's more than likely that when this person retires, they're not going to be adding anything more to the account. It's probably going to stay where it is. So we're also reducing our risk so that we don't see as much of a fluctuation. Again, this investor would likely shift their goals to preserving capital and generating income from their grown assets, and the investor would likely be advised to adjust their allocations over time to suit their new goals and objectives. So, what types of securities might this investor consider adding to their portfolio? Remember, we're sitting with 2 funds in it right now: total US stock market fund, total international stock market fund. So if you had to add a fund what do you think what would we put in there? Any ideas? What would somebody throw in there? Okay, we got a bond fund. All right, so yeah, we got government debt funds that we could put in there. We got investment grade corporate debt funds. We've got cash and cash equivalents, so money market securities, treasury bills, anything of ultra low risk, and even dividend paying or value equities. Remember how we talk about tilt? We might consider, all right, maybe we want to tilt a little bit away from the growth equities. Maybe we don't need so much volatility and total return, but we can rather go with cemented companies with strong dividends and maybe get a little bit of income and sort of participate more in that market. So knowing all of this, what's likely to be the investor's new risk tolerance? So now we're looking at our 5 different risk tolerances. So clearly, he was sitting up here in the aggressive growth category before, but now we've got sort of all of these different options. Now, there's more than one right answer, I'll tell you, because this person could be a moderate investor and say, I still want to grow my capital. I still want to leave some money left to beneficiaries. I still want to continue investing and seeing my capital grow. Or this person might say, you know what, I'm mostly concerned with generating a little bit of income. I don't really want to see the principal move that much. I just want to generate income for me to take off and leave the balance there so I can leave it to my beneficiaries. Or maybe they just go, I want to just keep as much of it as possible. I'll take interest payments only, but just preserve the value. So any of these options are totally fine. So there's different choices that you can make based on what you want, what you want to do. There's always going to be the best number value. There's the highest returns you could get and all that kind of stuff. But it also is really important to just think about what are those emotional things that would be important. Yes.
Been current income taking some and capital preservation.
So capital preservation is going to have a number one focus on just preserving the initial principal value, period. So while current income, you can have an income producing asset such as a Coca-Cola stock. That's not a capital preservation asset because it still has downside risk and volatility, right? So it will distribute income, but it's still very much at risk because it's a stock and the stock market can drop. Right, exactly. And even something like a high yield bond fund. Well, it's a bond, so it's less volatile than a stock, but it's still, there are risks associated with that versus something like a treasury bill or a money market fund is pretty much the closest thing you're going to get to guaranteed value that you can in the marketplace. So it's really just kind of like that shift from any risk at all to like get some decent stuff, but still keep things relatively safe versus literally try not to lose any of the original balance.
Something with the CDs would be the capital.
Yeah, CDs, treasury bills, money market funds. Yeah, it would be a very short list of available assets for this type of person. Yeah. So you should do more because basic allocations don't always protect us when markets turn sour. This isn't going to be sort of an advertisement to do you're actively trading or go do stock picking or trying to do the best, but it's important to not have the most complicated investment strategy, but to have a really good awareness of what environment you're in, of what products are available, of how things work in your portfolio, all of those types of things. So what we're going to do is we're going to talk about what we consider the things you should do for different times of the year. So there is a sheet and it's called portfolio monitoring, and it will go through all of the stuff that we're talking about. So you can take a look at this when you go home, but it's going to talk about things that you should do daily, weekly, monthly, quarterly, annually, biannually, things that you should do at these different time periods to make sure that you stay up. And also, if you have a good advisor that you appreciate, maybe it's one of those reasons to remind yourself of why you like them so much and why it's a good partnership, So on a daily basis, it's really important to monitor market news and economic indicators, not so that you should be making changes all the time. None of this is about trading every single time a topic pops up here. None of this is about making this giant change to everything. But it is important to stay up on the news and what's happening in the economy. For example, also staying up on tax code and financial legislation. I would argue these are even more important because yes, changes in the economy might change things about how you invest. For example, if interest rates are at basically zero, it'd be a little bit ridiculous to run around and buy every 30-year treasury bond fund that you could find, because now you're just adding this ridiculous amount of tail risk. Interest rates go up and boom, you get crushed and it never comes back. So yes, that's important. But even more important is to make sure that if things change in the tax code, is there a part of your plan that something got moved away or created not legal anymore? Or is there a new opportunity that now is suddenly legal? If you weren't paying any attention and you were high income and you paid all these taxes and you're like, God, California paying so much in state taxes and you weren't paying any attention, you might not have noticed that upcoming you were going to be able to deduct 4 times of your state and local taxes on your next tax return because of one of the recent tax bills. You may not know that when Secure Act 2.0 passed at one point, a lot of beneficiaries stopped being able to stretch IRA required minimum distributions over their lifetime. And now suddenly it's scrunched down to 10 or 15 years. These are changes that are important to know so that you know, okay, when this happens, I know how this is happening and I can cite the place where it's going to happen from. And it's just staying up on those things. That's what I think are the most important. On a weekly basis, honestly, listen to some podcasts, educational content, stay up on things. Make sure you are staying with, good information. Don't listen to too much, individual stock hype or anything much like that. Not try to stay away from marketing as much as you can, but it's good to just sort of know what's going on. I really like Bloomberg Daybreak. I like Bloomberg, period. I like a lot of their podcasts. I just go on Apple Podcasts and search at Bloomberg, and pretty much anything I know I'm going to have a decently good time because they're fairly unbiased. It's not a big shouting match, it's not debates. It's just information, stuff that's happening, ideas from left, ideas from right. And I find it to be a really good sort of good place to listen to just what's happening in news. So if I want to get just like a cap of the day, like top of my day, I might listen to Bloomberg Daybreak. Really, really good show. Big fan. ETF Prime is really good too if you like investment products a lot. So if you like really shopping through different products or being at the front end of what's going to come out, ETF Prime is great. Bloomberg Balance of Power is like the one political thing I will listen to because it's actually very fascinating and very non-biased, and it doesn't feel like just somebody trying to convince me of something the entire time. It really just feels like here's what's happening in the political climate, here's what the Democrats are facing, here's what the Republicans are facing, and it just kind of like it gives you this nice sort of non-biased, because that's just what I want, non-biased view of what's happening. Allworth Money Matters is also a really fun one because it's a show where callers call in to some local financial planners and they will ask financial planning related questions, financial advising related questions, and you get to get those answers from the perspective of people who are in the business just like we are. So it's just kind of like a show dedicated just for that. I don't agree with every single one of their answers, but across the board, 70%, we're going to be aligned on most things. So it's a really great place to just hear conversations like that. So even if you don't take their answer and go, I'm going to apply that, listening to how they process things and how they get to their different answers, that can be very great. So these are like my favorite podcasts that if you just wanted a small list of things to listen to, I would go for those.
So
yeah.
where would you recommend for beginners?
I would start with something like, I would go with Allworth Money Matters. I would say Allworth Money Matters. And then if you want just regular news, Bloomberg Daybreak. Those are the two that are like, if you just wanted to get 2 sources of information, something for current news and then something for financial planning related stuff, I would go with those 2. Those are probably my top 2. Yes.
There you go.
Mhm.
That's the only place I know to look for any of those. Where do I find them?
Yeah. So if you can listen to these on any of the places where you can look up a lot of these on YouTube, actually. Bloomberg posts all their stuff on YouTube, and They actually run a continuous live show on YouTube, as well as they have a cable channel, so you can watch them on cable as well. But for the most part, where I'm listening to these is through the podcast app on my phone, or through your music app like Spotify, or basically anywhere else like that. YouTube and their respective websites as well will also have a place for you to listen. So that's where I would be looking. Next up is reading investment education materials, books and articles, things like a random walk down Wall Street, or different things about the psychology of money, or even just psychology in general to understand yourself better, to apply that to your investment strategy. Research on passive investing strategies. You want to get real into the weeds, go for that managed fund that seems enticing or your advisor was going to recommend for you, and go download their prospectus and have a full read through that so you can actually understand what happens in the fund. Looking at different research on asset allocation principles and market fundamentals, and just understanding sort of how things work and why different asset classes perform the way that they do. White papers, just big research papers, not tiny little 5-minute YouTube videos convincing you why this bond is going to be the next big thing, or opinion articles that are just pulling sources from absolutely nowhere. Like, read real research material, books from professionals and people who have been in the industry, or investors, or that sort of thing. And obviously, love all those podcasts. Now, on a monthly basis, this is when I'd be doing some of your portfolio performance tracking and portfolio analysis. So whether you like to run your own stuff in your Excel spreadsheets, or you like to use whatever your broker dealer gives for you, or you pull it into something like Morningstar, this would be another great way to use Morningstar, because you can connect your accounts and view all of the stuff that, all of the stats that we're looking at, all of the standard deviation and the R squared and the beta and all of this stuff. You could see it for your portfolio put together if you link it, and it will automatically use those changes. So if you have something like a Schwab, a Vanguard, or a Fidelity account, very easy to link that to something like Morningstar. You can do the same thing with something like Yahoo Finance or YCharts if you have anything available like that. This is when I would be looking at things like position drift. So one of the things that's going to be important, we haven't really talked about it, and honestly, this will be something that I probably will introduce into slide material later, but determining when do you want to start rebalancing away from positions that have grown a lot into things that haven't so much. The easiest way to do it is just look at it in the whole, especially if you can plug it into something like Morningstar, and you can see you started out with a 60% equities, 40% bonds portfolio, and now you're at a 65% equities, 35% bond portfolio. That is not really that much of a difference, but if you like to keep things in line, that might be your opportunity to go, okay, great. Now you go look at each individual position and say, which ones are up the most? We're going to trim you back down to size and scoot you into another position. So overall, I would say maybe if your equities positions change by 5 to 10% or more on the whole of the account. So if you move from 60 to 70, I might take a look and see what's going on. If you move from 60 down to 50, I might take a look and see what's going on. So it just kind of like get an idea of when you want to do rebalance and be aware of it. You don't need to trade every month. Don't get too frequent on the trading, but just like, make little marks. What are we looking at? What's getting out of whack? What do I need to control? Holdings analysis. Review your individual holdings for expense ratios. And if you already know everything's golden, that's great. You could just pat yourself on the back every time. Market concentration and sector and geographic exposure to ensure alignment with your investment strategy. Now, one thing that's important, holdings analysis is not going to be too crucial when it comes to broad market index funds, especially if you're not somebody who's super concerned about concentration in different companies. But where it is going to be very important is when we get to more managed funds, or even passively managed funds, because all the stuff that they're doing can end them to concentrate more and more and more to one individual position. So one thing that can be helpful, and something that I do sometimes, is we'll look at the underlyings of the investment portfolio. So I'll just show you what I do in YCharts. You may have to do this holding by holding, but what I am able to do is go into here and I look at my underlying holdings. So I can see in this portfolio which individual securities inside the positions of my portfolio have the highest concentration, right? So I can look at this and I could see, wow, how interesting. NVIDIA has 2.29%. If that makes me uncomfortable, if I want to get that number under 2%, well, then I'm going to have to start looking what funds in my portfolio hold this stock. Now I can see, if I look between all of these different funds, you can see that this Vanguard Balance Fund has 0.76 of the 2.29% in my portfolio. The T. Rowe Price Growth Stock Fund has 0.45. The minimum volatility factor. How interesting is that? That the MinVol fund has NVIDIA as one of their top positions. Anyway, so these are all the different funds that I might consider reducing or replacing because of how much they contribute to that overall concentration. So that sort of thing is important to recognize as well. Yes.
They here. Now we're.
Right.
But how did they get there in the first place? Like from a conversation that somebody is helping you making the 40% and then
Mhm.
the risk and once you determine those parameters.
Yeah.
Now you're monitoring something that you did before.
Yes.
How did that first occur?
Right. So that was when we sort of went back and we built this sample portfolio when we were choosing different holdings for the different stages. This is that portfolio that we were looking at before. So if I go back to the holdings, they'll look familiar. So yes. So this was what we created back before when we chose what goes in stage 1 and we put this treasury bond ETF, what goes in stage 2, and we chose the balance fund and then the short-term corporate bond. So these were all things that we chose during one of our classes as we built a sample balance portfolio. So then from that, that's the basis from which I'm using to look at sort of analyze and look over this portfolio. Yeah. And so the other thing now is to review distributions and income streams. So just make sure that any systematic withdrawals, if you've got automatic distributions coming out of your account that are supposed to hit your account, your bank account every month, make sure they're doing what they need to do. If you're looking for a certain amount of dividends, or if you could be comparing what sort the taxability of the dividends and other income sources, just make sure everything is doing exactly what it's supposed to do and flowing to the right place. Another thing about dividends is if you're the kind of person that wants to take the dividends as cash, that's an option, but you have to make sure that that's what's happening because they can also be automatically set to reinvest back into the security. In fact, that's the default for a lot of portfolios because you get those dollars immediately reinvested, and statistically, that's the best for the lifetime total return. But if you want to take that out as cash, make sure it's verified that they'll pay to cash so that you can pull that out of that place. Yes.
So when you said that reinvestment, you're still on the hook for paying taxes.
Yes, no matter what, it'll be taxable.
So
yeah.
Enough money coming in somewhere else, you're gonna.
Yes.
Spend that then, right? So
right.
Pay
now. Yeah, you'll always pay your taxes. However, for the most part, when it comes to stock taxes, they're usually going to be, if you've held the stock or the stock fund for long enough, they're going to be taxed like long-term capital gains. So it's really going to be your 10 or 15% rather than, 24 or something like that. So it is a qualified rate, but you will pay taxes no matter what.
That is as income then. The reason I'm asking is like if people on Medicare get stuck with the IRMA, like is that going to?
Yeah, so nothing escapes being categorized as IRMA or escapes categories as income for IRMA. Nothing does, not even municipal bonds. Yeah, yes.
When you get dividends, are there different types of dividends? Like is one earned income interest dividend versus capital gains?
Yeah, so there are technically two types. Well, there's a couple types of distributions, but the main two types of distributions that you'll see from a fund is going to be a dividend. So an ETF pays a dividend, a mutual fund could pay a dividend, a stock could pay a dividend. And then there's also going to be capital gains distributions. Those normally don't happen from ETFs because of a specific kind of structure that they have, but mutual funds that buy and sell stocks within them, if they have net capital gains at the end of the year, they actually send that out to you in cash. And then you'll either buy more shares of the mutual fund or you'll have that. So you can have dividends from stocks that have been held long enough to be qualified, which means they get taxed like long-term capital gains. You can have stocks from dividends from stocks that haven't been held long enough that get taxed as ordinary income. You can have capital gains distributions from mutual funds that can be long or short term, usually going to be long term because they'll manage that. And then there's going to be dividends that come from ETFs, but they're not stock dividends because it was interest paid from bonds, which could be fully taxable for corporate bonds, state tax-free for federal bonds or treasuries, and then federal tax-free and possibly state tax-free for municipal bonds. But all of that income gets counted for IRMA. So if you're worried about your Medicare premiums, there's no income that's going to not qualify as part of that calculation. Yes.
So I'd ask this question, you mentioned capital gains. Could you say something in detail about capital gains?
Sure. So, well, there's two different types of there's kind of two different types of capital gains that we're talking about. You can have capital gains where you buy something like an S&P 500 fund, it goes up by a bunch, you sell it, and now the amount that it went up, that's your capital gains. And then you'll pay taxes based on how long you held it for. With a mutual fund, when they do the same thing, they're buying and selling. So they buy a stock, it goes up, and then they sell it, and now they have this capital gains. In order for them not to pay the taxes on it, they take that money that they made and they send it out to you in your proportionate portion so that you pay taxes on it. So it's kind of like a pass-through business in a way.
Okay, how is that sent to me?
It's like a dividend. It's just like a dividend. Functionally, it's the same thing. It arrives in your brokerage account right next to all your shares. Yes, but it is a capital gain distribution, but functionally it works exactly the same as a dividend.
I know. The capital gains, exactly where the money is.
Yeah, so that's actually something is, if you're not looking, you don't really know. There might be some letter in the mail from the fund or something like that, but if you're signed up for e-delivery, it might just be a random email. But I mean, I've seen situations where I go and I'm looking at different client accounts and I go, oh, wow, well, there's some capital gains distributions because there was not like a ringing bell, in the back of my office that let me know. But so it's something you have to, look at. And if it's something that you don't want to have to manage, that might be a reason to choose for it to be automatically reinvested so that as soon as the capital gains are paid out, they buy it right back in to that fund.
Nonetheless, it being paid, even if it's reinvested, nonetheless, I owe taxes on it.
Yes, correct.
For that year, I suppose.
Yes. Yeah, so that could be a reason why when comparing mutual funds and ETFs, if you have mutual funds, if they distribute capital gains, that's going to be taxable to you in the year that they're distributed. Versus an ETF, it kind of just continuously embeds into itself. It never gets sent out to you. It just keeps building. So instead of having you buy a mutual fund, it goes up in value, and then they send that value back out to you, and now you buy more shares. Instead, the ETF just goes up in value, and then nothing happens, and then it just keeps going up in value because of the way that they work internally. There's just some inside differences that ETFs almost never actually send you capital gains. They'll always send you the dividends, though, which is just a different thing.
So, I'm gonna check the second one that you said to go back up and this up and down. Is that taxable of that year?
Only when it's sold. So it's just like a stock. So the difference is you kind of got to think of it this way. Owning an ETF is more like owning a stock. Owning a mutual fund is more like owning a partnership. Because with the mutual fund, the taxes of the internal structure are actually passing out to you. So the gains that they generate in the way that they're doing it, because they're buying and selling things and creating these dollars that actually end up in their bank accounts with capital gains, that taxability now passes out to you as a small shareholder of that company. Versus with an ETF and with stocks, when they make money, the way that they're normally doing is they'll then declare a dividend and then they'll share it, or they reinvest it back into the stock. So for the ETFs, the reason that they don't actually have to pay out capital gains most of the time, and this was a fun thing to research that I kind of dove into, is they don't actually buy or sell investments most of the time ever. Like 99.9% of the time, they don't actually buy or sell anything. What an ETF does is when they create themselves, they create an ETF and they just generate all of these shares, right? And they're like, okay, we're going to do this thing. We're going to build all these shares and we're going to get ready to go sell these. And then they get into a conversation with somebody called an authorized participant. And this authorized participant is the one who their whole job is to provide stocks and bonds to ETFs. And so they go and they buy stocks and bonds at big, giant blocks so they can get at the most discounted price possible, get the best value for that stock. So they might go, the ETF might go, I need to have 60 shares of SPY and I need 40 shares of AG or whatever, I need a balanced portfolio. Authorized participant will go and buy up all of those things that it needs and goes, all right, great, we'll trade you this for the ETF shares. And so then the ETF gives all their ETF shares, just like as if they were holding stocks of their own. They switch them out. Now they own all the stocks and bonds. The authorized participant owns all the ETF shares, and now their job is to go sell those shares to the public. And so it kind of goes back and forth. And now once it's established, now the ETF might say, okay, hold on. I don't want to follow the S&P 500 anymore. I want to follow the NASDAQ. And so they'll call up that authorized participant again and go, hey, I want to get some NASDAQ instead of my S&P. Can you help me out? And they go, all right, hold on, give me a couple days. And then they go and they buy a big chunk of the NASDAQ index. And then they'll come back and they'll go, okay, great, you ready? And then they will swap the funds. Meanwhile, all this appreciation has been happening. The value of these assets has been going up, but it doesn't matter because no sale has happened. They've never sold anything. The ETF has never sold anything. They just traded things of equal value. They made an exchange. So no gain gets created, but the assets do change to the new thing they wanted. And so then the value just keeps growing and growing and growing. Very similar to if you bought a piece of rental real estate one day and you did 1031 exchanges for your entire life. It's the exact same process. You're just swapping for the next new thing of the same value and swapping and swapping and swapping, and just keeps going up, never paying any taxes. That's how an ETF differs internally from a mutual fund. Yeah. Yes.
Can they trade the cost basis for a favorable trade?
What does that mean?
If I have a lot of gain in one stock and I trade you for a stock that doesn't have much gain, but same balance, then when I go to sell that stock, if I did, I'd have a higher cost basis. So they can manage the tax liabilities when trading stocks. I can trade somebody a high cost basis for my low cost basis. So the other person gets the tax liability.
No, you keep your tax basis.
When I sell the shares.
Yes.
Whether they appreciate it internally, if the manager of the ETF, if they did want to trade a stock with an authorized participant, then you can trade a stock and get a stock that doesn't have much gain on it and give them our stock that has a lot of gain. So then when we go to sell, we have less tax liability.
No, because you maintain your basis. Just like in a 1031 property.
Sure, yeah, but internally, this is the benefit of the ETF is they have favorable cost basis trade.
Interesting, because you would have to pay taxes on that difference.
Not when they trade something.
I don't know about that. I don't know about that. I'm gonna research that and I'm gonna find out, but I don't believe you. Okay, so on a quarterly basis, this is when you might actually be assessing your rebalancing. So if you're gonna go do a trade and you're gonna bring it back to alignment, this is when you might determine if that rebalancing is needed. So if you've changed from a 60-40 to a 70-30, then this might be that opportunity to go, all right, it's time to peel back some stocks. For example, right now, stocks keep hitting all-time highs. They just keep going and keep going and keep going. If you've drifted far out of your risk tolerance, boy, is it time to start peeling back some of the equities and start managing that portfolio. Again, if you're at your current risk tolerance, if you're at the correct risk tolerance right now, there's no need for you to lower your risk tolerance because stocks are really high. Stocks are always really high. That's the thing about stocks. They keep going to all-time highs because they keep growing. That's how this game works. So just hearing the words all-time highs frequently, that should not be a fear indicator. That's actually just kind of how the economy works and inflation. That's how that works. So just making sure that you're at your correct risk tolerance. That's the thing that's important. Tax planning review is also great. So assuming, just kind of assessing if there's any tax loss harvesting opportunities, or if there's any distributions that aren't quite so efficient, or if you can do something better with some contributions, whether it's to tax deferred accounts or taxable accounts, or whatever the case may be. This is a great opportunity to sort of have a little bit of a tax assessment because you actually have a decent amount of data. If you're checking how to optimize your taxes every day, I mean, you're not getting very much new data every time you go to assess that, but every quarter can be pretty good, especially because the second, or for the most part, distributions from investments are going to be on a monthly or quarterly basis most of the time. They're either going to come out at the end of the quarter or at the end of the month or sometime in between. And usually it's either going to be those two or they're just going to save it for the end of the year anyway, which is incredibly frustrating for tax planning. May I just say, when a mutual fund decides we don't pay out any capital gains distributions until December, and then suddenly this big giant wad of cash shows up in the account, and you go, where did that come from? And now suddenly you owe a bunch of taxes on it. I got to say, that's one of the most annoying things about mutual funds for me. Holdings research. Also, just look into the landscape of investment products and see if there's lower cost or otherwise better options available. One of the tools I have available to me, I'm sorry, I just love to show off the stuff that I have that you guys, that's too expensive for you guys. But one of the things I can also do is, let's say I want to go to, I'm going to search for a technology. This one. This is just one that I hold because I liked some of the stuff in it. But we could see that it's got a net expense ratio of 0.35%. Now, I could say, how about we go ahead in here, and this one, I would like to find a lower cost alternative. That's one of my favorite features about this. This is just these little quick things that I'm able to do. But, okay. Zero results. Okay, but I want to get rid of some of these return things. I think it's limiting it because of these returns. But I want to just see if there are cheaper funds in this category, in the technology category. Okay, so here, for example, here we go. So now we've got a couple different funds. So if we see over here on the net expense ratio, we can find funds that are really inexpensive, like Fidelity's Information Technology Index. They are 0.08%. That's really inexpensive. The technology sector SPDR fund. This one here, the one that starts with the X, that's an interesting group of funds because it's a group of funds where they take the S&P 500 and then they break it out into all the individual sectors. If you like doing tilt, if you like tilting towards technology or healthcare or consumer staples or anything like that, this is a really interesting group of funds. It's not a specific recommendation, but it's just like an idea of how you can consider doing something like that. So you can see here that you've got the S&P 500 index all the way at the top, and then these are all of the different components of the S&P. One of the things that using sector funds could allow you to do, here's a fun idea. You don't like how much technology is in there? Fine. We're going to allocate these in the same way that they're allocated in the S&P 500, except I'm just going to omit 50% of the technology and put it somewhere else, like utilities or energy or consumer staples, for example. So sector funds, especially like this, can be a really great way to supplement part of your holdings. And if I wanted to get a much cheaper alternative to my fund, I could go from my fund to XLK and I would save 28 basis points or over 0.25% every single year in perpetuity, assuming it doesn't perform any better or worse. Biannually, this would be a great time to complete your portfolio rebalancing if you haven't done it already. You can kind of notice that I'm having you look at things more frequently, kind of assess it a little bit less frequently, and then act on it not that frequently. Because what we're not trying to do is overtrade throughout the year and just continuously try and stay super close to this allocation. Because part of the benefit of holding things is letting their gains run, letting things happen, letting the market actually perform like the market and not changing your allocation so frequently that you stop performing like it. Because then, you know what number might start going down is like your R squared. You might not perform as similarly to the market because you keep rebalancing things to the super tight level. So allow some fluidity, but do your rebalancing when it's necessary. Holdings replacement. If you find something new, for example, if I wanted to do that technology fund swap, this would be a great time to do it at some point, twice a year maybe. I'm looking at it, I'm going, okay, it's time for me to get rid of that fund and put this one in here. Now, you might have an advisor that's doing some more frequent trades than this for good reasons or for not. Saying that you should do this on a biannual basis doesn't mean that nobody should trade any more frequently than that, or that you should, like, if you have 10 trades to do, split them off over a few years. You don't need to, follow everything like this so hard, but it's just, again, to make sure you're very calm when you're doing this, that when you're taking these actions of portfolio rebalancing, that it's been a nice, long, researched process, and that really your whole mind is going into that. Also, insurance coverage reviews are good. This is when you should look at your life, liability, long-term care, and other coverage levels, and also include self-insuring as part of this. So if you don't have long-term care, you're expecting assets to pay for it, look into what are things costing, how many years do I think I'm going to stay here, do I think I'm going to live longer than the average, shorter than the average, live the average, how many months is that, really look at the math and what goes into that and how that's going to affect your holdings and how much you need to either conserve or return in order to pay for that. And on an annual basis, if I may say, I think this is the most important thing. Everything else was about details. Everything else was about smaller things. It was about economics and politics and tax code and all of that stuff. And that's all really, really important. It's good to keep things optimal. But the most important thing is to review yourself. And that's to make sure that your overall strategy still is what you want. Make sure that reviewing yourself actually shows you that, wow, I created a really good plan because all of that speaks to what I feel right now. That when I read this piece of paper or I think about the things that I've put in place, I go, yeah, I did this because of this reason and it totally makes sense to me, and that's great. So objectives, risk tolerance, and any changes to these things. Complete financial health checkup. Just look at your accounts. Look at everything. It doesn't mean anything needs to change, but just look at the stuff. Look at what investments you have, how they're titled, what the beneficiaries are on them, how they transfer when you die, what kind of estate planning documents do you have, who's your financial power of attorney, what's in your advanced medical directive, who gets your insurance policies, how much coverage do you have, is there something lacking? We need to see the full picture every year to make sure that we're still on track. Your investment strategy and allocation review is also important. Assess whether your investment approach still aligns with your long-term goals and life changes. Even if you watched a documentary and now suddenly you have one ESG preference that you cannot budge on, fine. Let's figure out how to work it in so that your investment portfolio aligns with your objective and you're good to go. Don't be scared of change. If something about your portfolio or your needs change, don't hesitate to act on it. You are the advisor here. You are your own fiduciary. Even if you have an advisor, it's still your responsibility to make sure that everything happens the way that it needs to happen, because you're responsible for the advisor you pick. You're responsible for the choices you make, and you're responsible for everything. This is your life and your nest egg and your responsibility, and especially when it comes to passing it on to the people in your life, passing the information on to the people that you love. You've seen how confusing a lot of this can be, how muddy the waters can get, and how easily things that sound like easy solutions to complicated problems can be sold to people who are unaware. So it becomes your responsibility, the more that you understand, to help other people stay in the clear waters and make sure that they go in the right way as well. Now we're going to talk about some of the less fun times in the stock market. It's important for us to look back into our history with the stock market and see what kind of downturns we need to guard against. But at the same time, it's equally as important to understand exactly what level of downturn we can and have already recovered from. There's a lot of fear that comes up, especially when, equity markets start reaching and things in the economy don't look so great, but the stock markets just keep going and going and going, and people are talking about bubbles. We're so obviously in a bubble and all this and that. And there's a lot of fear. A lot of fear, and everybody always says, well, it's different this time, because it's been different every time, because it is always different. But it's important to see what we still have recovered from even then. First of all, let's make sure we get our definitions straight. There's a correction, which is usually defined as a decline of 10% or more in the price of a security from its most recent peak. So from the most recent high that it's had, if it drops by 10%, that's usually a correction. Something like in April of this year, that would have been a correction. Maybe a little, it was just kind of a gentle correction. It was not too much, it was about 10%, 8% at one point. But that would have been a correction. A stock market crash is a sudden and sharp decline in the value of stocks, typically defined as a double-digit percentage loss in a major stock index. So again, that kind of correlates with correction, but I think stock market crash would be something that stretches a little bit more into the, the teens and almost to the 20s or the 30, when we're getting into bigger double-digit numbers, not just 10 and 11. That's still our correction. Now, a recession is a prolonged, broad, and significant downturn in economic activity, typically measured by 2 consecutive quarters of shrinkage in GDP. So really, this is more of an economic thing. It's not necessarily a stock market performance measurement. It's more of what's happening economically. How much are we producing as a nation? Now, a depression is a severe and prolonged downturn in economic activity, often defined as an extreme recession that lasts 3 or more years that leads to a decline in real GDP of at least 10% in a given year. So again, these two are more about the actual stock market. These are more about actual economics or our economy. So here is an interesting chart. This is the S&P 500, and here we're showing its drops from its highs during recession. So the purple line is, again, it's sort of that downturn chart. It's showing when you see it flat up at the top, that means it's at an all-time high, and then it's the drop down from that we're measuring. Each of these shaded gray areas are recessions. I'm not going to pretend to remember the names of every single one of them, but trust me when I say that they're recessions. So you can see what sort of downturns that we've had. In 2008, nearly a 60% drop in the value of the S&P 500. More than half of the money just gone temporarily, but still. Dot-com bubble, similar story, though not quite as much. Between the 70s and 80s, similar story as well. And then even 2020 was pretty strong. That felt pretty bad. That was maybe 30%.
Does that time between 2008 and 20, does that represent the recovery then?
So the recovery would be this period here.
Yeah.
Yeah, right here. Yeah, and so this would be that 2008 through 2009 sort of crash.
So over that 10-year period, would you say the recovery, or less than 10 years perhaps, the recovery?
Yeah, the recovery definitely lasts. I believe the recovery for that one was about 6 years for it to fully get back to its peak. 5 or 6 years, I believe. Yeah, I think that's about the average for recovery from recessions as well. So here we can see sort of those recovery periods actually that we were just talking about. So here's 2 of them. One of them from the dot-com bubble. You can see from the high measured, it's in 2000. So all the way until June of 2007 for that to reach back up to its peak again, which again, if we're talking about long-term planning, remember the stages of our portfolio, that's about the maximum that's where we start with our stage 3 investments, is that 7-year period, 7 years plus. So I wonder why we chose a number like that, because it very closely reflects that of the recovery time of recessions in the market. It gives us the time for those returns to come back and not let it be this big giant downturn. Sort of similar thing here with the 2008. You can see it dropped in October of 07 and then came back up to its peak in April of 13. So again, about 6 years.
So we have names for them. The
Sure.
dot-com, the housing.
Yes.
And now we're in the A.
Yes.
So don't worry about it, and yet there is, this happening. Is there anything that can predict, okay, watch for this parameters or
Nope.
watch for this going, is there anything?
I mean, some people will say yes. I'm going to say no because they're always really easy to identify afterwards. Yeah. Like right, like afterwards, it's just kind of one of those things. I wonder if I can maybe just grab a sheet of paper or something like that. It's like I wonder what we could do to predict. Yeah, just like if you were to only look from back here, I wonder what you could have done to predict that drop. Anything at all? 2008 was interesting. Now, I wasn't exactly, prime investing age at that time. I was a little young for that. I was getting started, but there were obviously some problems in the underlying securities. I don't know how easy it would have been to get that information and to see that or to know to look for that. Nowadays, maybe there is some sort of concern that there's sort of this just wheel of investment capital going back between 3 to 5 different companies and not really ever going anywhere. And it just keeps going around and around and around. And the only reason it increases is because of stock price increases, because of demand. So there is something to be said about that. But again, how do you determine when? You just can't. And so if there's, part of your investment philosophy that wants to, take that into consideration, maybe that's when we start really sort of aggressively tilting away from concentration in companies like that. Overall, for the broad market will recover. But when it comes to those short-term things, maybe there are things you want to tilt away with because you just see a level of risk that just is not comfortable for you.
The wisdom is in monitoring and balancing.
Yeah.
What the.
Yeah,
the
and just
reasons.
yeah, and just really staying diversified across multiple asset types and not allowing too much of your dollars to be at risk to one particular thing. Yes.
A lot of people will watch unemployment, right? Cost of interest rates, trade with a lot of these companies. If you are concerned and want some help in that area, then you go to the managed funds where managers promise to watch all these variabilities in the economy. And there are different funds in that second category Nash talks about that will do just that. They will monitor, let's say, 4 different categories. And when it falls out of that, they'll immediately rebalance. Now, they don't always turn out to be true because there's so many times where a crash happened, nobody had an idea. And a lot of the crash is human emotion or fear. And then the traders get out to watch us fall further and then they get back in. So there are funds out there that do semi-manage and watch all these categories. But it's like buying options on things. You could wait for 3 years, it never happened, and get back in and then it happens. So that's why he plans out your particular portfolio based on timing. But a lot of people are fearful all the time. I've heard this in 45 years. Well, AI is going to ruin the market. It might ruin some people's day, but the market will adjust likely. But it could cause a big turn down, or maybe this president, that president. So that's why his planning process works, because we don't know when the next bomb's going to blow up. And we need a correction in the market. Like a forest fire needs a fire occasionally. We haven't had any for a while, and it would be due time because some of the price, per earnings have gone up pretty high. But we can't predict anything in the short term. Gotcha.
Okay. So kind of calling back a little bit to that ETF conversation we were having about, he looked up his source and texted it to me so that I could make sure to go over that and see how it works. So essentially what we were talking about ETFs exchanging their inside holdings, right? And how they do that for, swapping new holdings and stuff like that. So what they essentially do is they'll choose specific lots that have different cost bases. So for example, This happens all the time with regular investing too. You buy NVIDIA. Let's say you bought it for $50 a share at one time, and you also bought it for $100 a share at one time. Your average cost is $75 a share, but each of those purchases have different costs associated with them, and they're called different tax lots because that lot, that time you made the purchase, has a purchase price associated with it, and that's your cost basis. So essentially what he was discussing was the idea that if the ETF is sitting on multiple purchases of these different or multiple different, bits of this stock, if an authorized participant wants to come and redeem their ETF shares, they want their money back or they want the securities, instead of selling off the NVIDIA shares and then giving them the cash like a mutual fund would normally do, what they'll do is they'll look at their different tax lots and go, oh, okay, so this one that has the higher cost basis, I'm going to give them that one because effectively it's less of a taxable event that is occurring. So they're managing their costs and not paying as much taxes on that. It's a little bit complicated of a concept that is never going to touch any of our accounts, but at the same time, it's just kind of part of how they manage theirs.
Means that ETF that trades internally does all the exchanges, but they don't surprise you with the capital gains that you never physically got, but got reinvested. So an ETF is definitely more tax efficient.
Yes. On average, the stock market takes approximately 2 to 2.5 years to recover from a recession. That's interesting. That sounds really short, right? The Great Financial Crisis took about 5.5 years for the S&P to return to its peak. Dot-com bubble took around 7 years. Now, this is why it feels so much longer to us, because the most recent recessions have actually been the longer ones. Besides, obviously, the Great Depression was a much bigger. But when we're talking about recessions, these sort of still substantial but not extreme and severe, they average about 2 to 2.5 years of recovery. COVID-19 recession only took 18 months. In terms of the stock market, we had basically forgotten about it by the time it happened. It was such a quick recovery, such a strong recovery, and all these AI companies, all the tech companies, they just kind of got going because there was nothing physical. Everything went online. It was like, now there's all this interest, and then AI followed it immediately afterwards. So the tech companies just have been on a roar ever since then. So here's a slide from T. Rowe Price. And the source for this is called The Case for Staying Invested Through Volatile Markets. If you want some reassurance of why you should stay invested with your plan, look this up. The Case for Staying Invested Through Volatile Markets by T. Rowe Price. In fact, Shaniqua, if we could send that out in an email, that would be fantastic. Thank you. So you've got a couple different things here. So you have the market hit its bottom. When the market hits its bottom for each of these different time periods, like June 1962, June 1970, September 1974, July 82, November 87, September 2002, and March 2009, we have also on the left here return figures. And we have different bars that represent different periods of time. The shortest period of time, the darkest blue, being 1 year later, and then 3 years later in the light blue, 5 years later in the dark gray, and 10 years later in the light gray. This shows the return since that market bottom from that date. So June 1962, the market hits its bottom. 1 year later, it's up 35%. 3 years later, it's up over 20%. June hits its bottom 1970. 1 year later, it's up 50%. 50%. September 1974, almost 15%. July 1982, 16%. March 2009, also above 50%. The point is, it's important to stay invested because do you notice a trend about when the highest returns shown happen is in the shortest time frames after the crash. Right after the crash is pretty much always the highest return. The average return after bear markets after 1 year is 38.4%. If you sell out and you don't buy back in exactly at the bottom, you miss most of that. You miss most of that. 3 years later, it's almost 20%. 5 years later, it's almost 18%. 10 years later, 13.62%. And I believe these are annualized, like yearly numbers. So it's really important to stay invested because these are the types of returns you miss out on. Because can you imagine if you were through all of these, but you were a panic investor and you sold and stayed in cash for a year, 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 and you missed all of that? That would be a huge detriment to your returns. Fidelity also has some research on staying invested. Don't risk missing the market's best days. This is one of my favorite studies to quote, and I'll quote it all the time. I don't care what's happening in the market. We have here in hypothetical growth of $10,000 invested in the S&P 500 index from January 1st, 1980 to December 31st, 2022. Initially, you'll start with $10,000. And if you stayed invested every single day, never took a dollar out, you let every dividend reinvest, you just stay just from $10,000, you would have $1,082,309. If you missed the best 5 days from 42 years of market performance, you would only have a balance of $671,051. If you missed the best 10 days, 483,000, less than half of the return. If you missed the best month, 1 month out of 48 months, you would have 2/10 of the amount. And if you missed the best 50 days, you wouldn't have even gotten to 100 grand. It's always important to think long-term and remember these. Because again, even earlier this year, remember in April, remember when things dropped really hard? Immediately after the worst day, I think it was, I remember because we were doing a class at the time and people were, they were talking about it. They were like, what are you changing because of all the tariffs and all that? Everybody was freaking out. I remember particular people like calling me out about it. I'm like, we're staying invested because we're invested for our risk tolerance. It goes down, market's down 8% for the week. And they're like, I don't know, it looks like we're just going all the way down here and getting really, really doubtful. Come back next week, what happened? Market popped by 10% in a single day, Now that's not to say that that's a market prediction or anything, but it's just showing from the data, this is what happens. It goes down and then it pops right back up if it's going to recover. Now there could be time in between. Absolutely there could be time in between. But it's just important that if you're going to invest, pick your allocation and stick to it. Don't try and miss the best, or don't try and only get the best and miss the worst. It just doesn't happen.
So one question about that, how do you deal with the crashes then? So I can see the notion of state as the group. But are the crashes totally different than this concept?
Well, it's kind of the same thing because you really just want to stay invested along with your risk tolerance. Is really just staying invested. So as long as your plan already sort of takes into account a lot of these things happening, that's what you want to do. That's why your investments might be slightly more aggressive or slightly more conservative than you originally thought, because you have to take these things into account and plan for it. Because usually the thing that's going to make those crashes make your portfolio perform even worse is you changing it, and now suddenly those things that lost value don't get any time to recover and bring back the value. So it's really just sticking along with the plan and knowing that you crafted it for that purpose, because that's what you should build it for anyway. Many of the stock market's best days happen during the market's worst years. It's 50 best days. Half of them are during a bear market. 50 best days of the stock market. Half of them are during a bear market. Half of them are during the first 2 months of a bull market, or a quarter of them, and a little bit less than a quarter of them are during the rest of the bull market. But the best days, stock market's best days, half of them are in bear markets, not even in bull markets. Bull markets give us all this wonderful time of going and going and going, but the best days don't even happen then. That's just cumulative effect. So good luck trying to time that. Remember, we were looking at this. You don't want to miss those best 10 days. But if half of them are in a bear market, why would we rotate out during a bear market? Because now we're going to miss those days. All of these stats are not to push you to fully invest in equities. Of course not. Of course we're not trying to get you to invest fully in stocks. All that I want is for you to craft a plan that you can stick to. You can marginally lower returns are not going to be your end. If the stock market does 12%, if your neighbor does 15 and you do 7, that's not going to ruin your life. You'll be okay. But if you miss returns entirely because you went to cash and the other guy just kind of forgot that his 401k existed, he's going to do way better than you, even though you tried to outperform. The point is to find your comfort level and stick with it, because it's the consistency that matters. Plan your stages, be honest with your stomach for risk, and just keep swimming. Just stay in the game. Just keep moving along. And with that, that brings us to our time. So do we have any questions, any comments on any of that?